Hi everyone, welcome back to Corporate Decoder, the place where we break down the money behind the business world. And today we're diving into Fidelity Summer Street Trust's latest report, a document that tells a pretty wild story about where our money is going and if it's actually working for us. This filing is all about how different Fidelity funds performed over the last year, and it's packed with numbers that can seem a little dry at first glance, but trust me, there's a lot of juicy intel hidden in here about the market and how these investment giants are navigating it all. Before we dive deep, if you like getting the real scoop on company finances and want more breakdowns like this, make sure you hit subscribe and join our Discord community linked in the description below. You'll get to connect with other finance enthusiasts and stay ahead of the curve. First up, we have the Fidelity Sustainable US Equity Fund for the year ending May 31, 2025. It seems the big story for them was the hot US stock market in this period, fueled by corporate profits and a potential shift in interest rates from the Federal Reserve. But things got a bit shaky starting in February, with investor optimism dipping due to some government actions and policy shifts, especially around tariffs. So even though the market overall did well, their investment choices, what they call security selection, actually hurt their performance compared to the broad market like the Russell 3000 index, especially in technology. They also saw weaker results in utilities and healthcare. For example, they were underweight in Broadcom, which shot up 84%, meaning they didn't own as much as they could have. They also had a stake in ON Semiconductor that didn't pan out, and Meta Platforms, which they just started investing in this period, also didn't help as much as hoped. On the flip side, where they did well was in energy stocks, and picking stocks in materials also boosted their results. They were also a bit overweight in industrials, which means they owned more than the average fund, and that paid off. Even their cash holdings helped their relative performance, which is interesting. Looking at their top investments, Nvidia Corp was a big one at 83% of their net assets, followed by Alphabet Inc. Class A at 7.9% and Amazon.com Inc. at 7.2%. These are all tech giants, showing where the fund is placing its bets. Now let's switch gears to the Fidelity Climate Action Fund, also reporting as of May 31, 2025. Their performance was tied to global equities doing well, thanks to a strong global economy, lower inflation, and a weaker US dollar. However, they also faced challenges like slowing earnings growth and those shifts in US tariff policies. Similar to the US equity fund, their security selection, or how they picked individual stocks, was a drag on their performance compared to the MSCI World Climate Change Index, particularly in information technology and consumer discretionary sectors. They missed out on a big gain by being underweight in Tesla, which jumped 95% during this period. Not owning Broadcom, another big gainer, also hurt their relative performance. But they did benefit from an overweight in Gilead Sciences, which gained 56%, and an investment in All Solutions, which also performed well. In terms of top holdings, Microsoft Corp led the pack at 6.2%, followed by Nvidia Corp and Apple Inc., both around 5.1%. This shows a strong focus on well-established tech companies. Next up is the Fidelity SAI Sustainable Sector Fund as of May 31, 2025. Similar market conditions influenced this fund, with US equities performing strongly but facing volatility later in the year due to governmental actions and policy uncertainties. Their security selection was also a detractor here, especially in information technology and communication services, where their stock picks in semiconductors and media hurt their results. Again, we see an underweight in Broadcom as a major detractor, and a stake in Apple also weighed on performance. Micron Technology, a stock they increased their investment in, actually hurt their results this period. On the positive side, their stock picking in industrials made a good contribution, as did an underweight in energy and an overweight in financials. Leading their holdings are Microsoft Corp at 8.6%, Apple Inc. at 7.4%, and Nvidia Corp also at 7.4%, indicating a concentration in major tech players. Then we have the Fidelity SI Sustainable US Equity Fund, also as of May 31, 2025. This fund faced similar market dynamics with strong US equity gains but later volatility. Their security selection was a detractor, particularly in information technology, and their stock picks in utilities and healthcare also hurt their performance. We see the same theme with an underweight in Broadcom being a large detractor and a stake in ON Semiconductor that didn't work out, plus a position in Meta Platforms that they established this period. However, energy stock selection and materials also helped their relative performance along with an overweight in industrials. Their cash position also contributed positively. Top holdings were Nvidia Corp at 8.3%, Alphabet Inc. Class A at 7.9%, and Amazon.com Inc. at 7.2%, again showing a strong weighting towards these tech giants. Next is the Fidelity Agricultural Productivity Fund, also as of May 31, 2025. Global equities overall had a good year, despite challenges like slowing earnings growth and tariff policies. For this fund, stock picking in the US and an underweight in India detracted from their performance when compared to the MSCI Assegai Select Agriculture Producers Index. Their stock selection in fertilizers and agricultural chemicals was a problem, as was an overweight in agricultural products and services. They also took a hit on biotechnology investments. Their holding in Lamb Weston Holdings, which they decreased this period, also performed poorly. But they did see positive contributions from stock picking in agricultural and farm machinery, and an underweight in packaged foods and meats also helped. Their top holding was Diranab Co. at a whopping 25% of their net assets, showing a clear focus on this agricultural machinery giant. Let's look at the Fidelity Water Sustainability Fund, also as of May 31, 2025. This fund's performance was influenced by global equities in general, but they saw a detraction from stock picking in Europe, specifically Switzerland, and an underweight in water utilities. Not owning Belima Holding, a company that did really well, was a big miss, and a stake in KBR, which they actually increased, also hurt their results. They also held Ingersoll Rand, which performed poorly despite being a large holding. However, an overweight in the UK and a strategy in emerging markets, particularly India, were positive contributors. Their top holdings were all in utilities, with United Utilities Group plc at 7.9%, Severn Trent plc at 7.8%, and Essential Utilities Inc. at 5.6%. This fund is clearly focused on companies involved in water infrastructure and services. Now, moving to Fidelity Climate Action Fund again, but looking at different classes like Class C and Class Z, as of May 31, 2025. The performance commentary is largely the same as the other climate action funds, focusing on global equity gains amid economic resilience, but with headwinds from earnings growth deceleration and tariff policies. Security selection in the US and Europe ex-UK detracted from performance, particularly in information technology and consumer discretionary sectors. We see the same detractor here again, being underweight in Tesla hurt them, as did not owning Broadcom, and an overweight in First Solar, which lost value. But they did benefit from an underweight in healthcare and good stock selection in energy and utilities. Their top holdings are dominated by tech again, with Microsoft Corp at 6.2%, Nvidia Corp at 5.8%, Alphabet Inc. Class A also at 5.1%. And finally, Fidelity Voluntary Savings Plans, also as of May 31, 2025. This filing seems to be mostly boilerplate information about other funds and standard corporate disclosures. What's really interesting here is the consistent theme across these reports. You see a heavy concentration in technology stocks, especially the giants like Microsoft, Apple, Nvidia, and Alphabet. This is understandable given the market's focus on AI and tech innovation, but also represents a significant bet on a single sector. Looking at the financials, some funds had substantial total advisory fees. For instance, the Fidelity SAI Sustainable Sector Fund has $1,087,655, while this is for managing a portfolio of nearly $400 million. It's always worth watching how these fees impact the ultimate return to investors. On the flip side, the net investment income loss line in the financial highlights tells us how efficiently the fund is generating income from its investments after expenses. For the Fidelity Climate 7.1%, which is good, but for the Fidelity Climate Action Fund, it's negative. Sitting at negative 0.510 means that fund is currently spending more on operations than it's earning from its investments, which is something to keep an eye on. It's also important to note that the fees can change, as mentioned in the How Has the Fund Changed section for the Fidelity SA Sustainable US Equity Fund. These changes are usually tied to management fees, operating expenses, and expense reductions, meaning the cost of investing can fluctuate. Then there's the audit fees. Deloitte and Abb, Tussell and PricewaterhouseCoopers LL billed millions in fees to these different funds. For example, Deloitte billed over $1.5 million for audit-related fees and over $14.5 million for audit-related fees and over $14.5 million for audit-related fees and over 14.9 million linears for audit-related fees and over 14.9 millions for other fees. While necessary for transparency, these costs do chip away at investor returns. A significant part of these filings also details shareholder votes. In this case, a special meeting on July 16, 2024 showed overwhelming support for electing the Board of Trustees across multiple funds, with affirmative votes consistently hovering around 94%. This indicates shareholder confidence in the current leadership overseeing these investment vehicles. So what's the story here? Fidelity is heavily invested in the tech sector, which has been a strong performer, but this also concentrates risk. Some funds, like the Climate Action Fund, are still finding their footing in terms of generating net investment income, while others, like the Agricultural Productivity Fund, are really growing. Keep in mind that these reports are a snapshot in time and performance can change rapidly. Overall, Fidelity seems to be navigating the market fairly well, but the heavy tech concentration is something to watch. The key takeaway is to always understand what you're investing in and how the fees and expenses impact your actual returns. Alright, that's our deep dive into Fidelity Summer Street Trust's latest filing. What do you think about their investment strategies and these financial numbers? Let me know in the comments below. If you found this breakdown helpful, please give it a thumbs up and subscribe to Corporate Decoder for more. And don't forget to join our Discord community, linked in the description for more insights and discussions. Thanks for watching, and I'll see you in the next one.